Welcome to Kentucky Horsepower, the official podcast of the Kentucky Automobile Dealers Association.
Hi, everyone, and welcome to another edition of Kentucky Horsepower, the official podcast of KADA. I am your host, Jason Wilson, president of KADA, and joining me today is a familiar face in a different place, Kevin Tynan, director of research for the Presidio Group. So, Kevin, let's start with that. You and I have been doing this for a number of years now, and you've spoken at conventions again for years. You've been a keynote speaker that we've worked with through the years, but that was always with a different employer, a different venue, and now you are with Presidio Group. So let's talk about that and what your new role is, and about Presidio Group in general.
Thanks, and it's great to see you again, Jason. Always. Yeah, it was time for change. 15 years at Bloomberg, building that automotive coverage, really from nothing, from absolutely nothing, and now that department is about not just auto, but the entire department is about 400 people, and in getting in discussions with Presidio Group, they recognized a real need for objective auto industry analysis, and they really wanted to be out there as a thought leader in the space. Now, the core business for the Presidio Group is dealership M&A advisory. There's also an automotive technology investment banking division, but I'm completely, and my group is completely autonomous from that, right? We're out there, we're doing our analysis. Jason Stein, who you may know from Automotive News,
Yep.
is on the team. Amy Wilson and myself are really out there trying to tie it all together, and not just internally for the Presidio Group, but for the dealer groups, for the manufacturers, and to because it's difficult to look to Wall Street, right, for real objective analysis. That's investment focused, and it's very different. Very knowledgeable people, great data, but the finish line is in a different place for those kind of analysts than what we're trying to do, right? And we're really focused on the franchise dealer base, how to create efficiencies, what to watch out for, what's on the horizon, what they do right, what they do wrong, and that will ultimately, I think, tie together what the Presidio Group is doing on both ends, on the dealership M&A side, where the opportunities are, where the value is, and then on the investment banking side, where there's efficiencies that can be created, cost savings, and things like that. So, what I tell people is I am the exact same role. There was no learning curve on what's going on in the industry. All that's the same. The only difference is I'm wearing a different uniform, and now we're building the processes of being able to write and research and analyze and publish our findings for everyone, really. And it's not
Right.
just the internal group, it's for everyone. So really exciting. In a way, it's a little bit of a startup. Going back to where I was in 2009 with a blank sheet of paper saying, what is this research department gonna look like? We're a little bit ahead of that, because we have some other team members, but
Sure.
I think we have a clean slate to go and create what we want to create and what we think will be the most effective in the marketplace.
Well, it sounds like an exciting opportunity for sure. In that, once again, you're building something. But to our audience members, it's great to hear that essentially your role really is the same: is to provide insight, analysis that you've derived from a system of working through the years, and how you develop that and share that information. So we're excited to have you. And you mentioned a couple things that I'm going to jump into on this podcast as we talk about kind of the state of things today, where things are going, things to be looking at. So all the things you just sort of mentioned is what I wanted to sort of get your take on today as we enter. We're a couple weeks out from Christmas now, and heading into the new year before you know it. And I thought I'd start with the aforementioned automotive news. There's a headline here that I felt appropriate to at least start and get your take on this subject. So the headline in this article on the front page of Automotive News, this is the December 2nd edition. Dealers are anticipating golden age with Trump. Policy changes could create a boom in buy-sell action. And this is by Julie Walker and Gail Kashidorian Howe. Hopefully, I didn't butcher that too much, of Automotive News. But I thought I'd get your take first on that. We've obviously had a presidential election that fortunately for all, whether you were happy or unhappy, at least it was decisive in that we know who, in fact, is going to be the president for the next 4 years, and that was very clear. So now that we are in this, as we the president elect transition is underway, and what do you see? How does that headline hit you as far as golden age with Trump, given all the things going on? And of course, we're dealing with EVs, we're dealing with all these things that presumably there's going to be some differences in policy versus what's in place. So, Kevin, what's your take on that?
And I think, you're right. The removal of uncertainty is always big in any market, in the stock market, in industry, in marketplace. So if there's a little bit of visibility for the next 4 years on the mindset, certainly that's helpful. I think, though, that fundamentally and structurally, the industry globally, and this also spills into the regions, is super, super overcapacitized, which has to be fixed, right? And essentially, that's what a trade war boils down to. Is China builds a ton of capacity, right? A lot of people, a lot of units they sell every year. But when demand slows down and you look at capacity and supply relative demand and there's too much, you turn to other markets, right? And you say, well, we'll sell more in Europe. We'll try and break into the US. And eventually you get those countries say, hey, we have our own capacity issues. We're not taking your excess. That's your capacity problem that you have to deal with. And that's kind of where we are. And I think what we've had historically, if you think about going back to the bankruptcy period, 2008, 2009, right? We sort of maxed out demand and U.S. volume, new vehicle volume at, call it 16, 17 million units. Then we get this giant drop, right? It goes to 9.5, I think, at one point. And then everything, costs get rationalized, right? That bankruptcy period, debt is forgiven, right? Union contract is
Right.
renegotiated, factories are closed, brands are gone, right? And so now you have this super, super lean cost structure, gutted actually, while volume is recovering, right? So it's this wild profitability. And then you bring back some capacity, and then we get to 2016 is the peak of 17.5 million units, right? Then we hit the pandemic, and then there goes volume again, right back down. And there was some cost rationalization as a result of that. And then you're building up and building up. I think the problem this time is that this might be a 16 million unit market legitimately and profitably, and anything above that becomes a problem, right? There goes your pricing power, there goes your margin integrity. And we could do 17.5 million again. We could do 18 million. We could do 20 million. You name the number. The question is, what does that deal look like? And I feel like above 16 million, those are really bad deals for the retailers, for the manufacturers. So what do you do when you're constantly bumping up against this 16 million organically good and profitable number? But your break even is going up, you have to address costs. And I feel like we are at this point in this very, very long and giant cycle that says this isn't going to be solved by selling more units anymore. This has to be about taking out capacity in the US, in Europe, in China, because you got to lower that break even as opposed to dealing with your higher break even with higher volume. We can't get it, right? We can't get it profitably anymore.
Right.
So you really have to, and you're starting to see it, right? Nissan, Ford, a lot of automakers are talking about structural costs, taking out capacity, taking out headcount, and
Right.
it's painful. But I think they're slow to do it because it's tough to add it back, right? But I just don't see it coming back profitably. The other problem too, Jason, is that, right, the main driver for the past 10, 11 years, really since 2013, has been, and I've talked about this a million times, the shift to truck from car, right?
Yep.
Higher revenue per contribution per vehicle, higher profit contribution per vehicle. And what winds up in 2024 and 2025, we have an average transaction price above $48,000, right? So
Hmm.
just simple business economics say you're just not going to sell as many units if you're trying to sell $50,000 vehicles all day.
Right.
Um, so when volume was the highest in history in 2016, it was a $35,000 market. Very different. There's a 40% gain in ATP, the volume just won't be there. It's just a simple trade-off. Now, the good news is that, and I talk about this all the time, the revenue pool, when you take that transaction price and multiply it by the volume, actually makes the market much bigger than it was in 2016, right? By $140 billion, it's much bigger. The problem
Sure.
is that there's a lot of automakers that are at max truck mix, right? Ford has one car left, Mustang, right? So they're
Right.
98% truck. So where do you go? And the problem is if you can't continually drive that pool bigger, whether it's by volume or whether it's by pricing, you stagnate and then costs continue to creep up, and now you have a problem. And I feel like that's right where we are right now. And you talked about EV. The problem, I think, also is that as we get to the end of this truck versus car runway, the conventional wisdom was, well, EV will be that next step higher, right? They're
Right.
they're more
Right.
expensive vehicles. There's more technology. There's better margin in them. We'll just go from 10, 11 years of truck mix to EV mix. And we know what's happened there, right? And the profit profile just can't support that transition at this time, right? So we're at this really, really difficult crossroads that says we're not going to do it with volume. We're not going to do it with richer mix. So let's look at the cost side. And I think that's what 2025 is going to be a year of.
Yeah, it's interesting. In fact, in kind of preparing to talk to you today, I was looking at just, again, we're at that time of year where we're seeing these various forecasts and what to anticipate and expect. And I saw Cox Automotive put out not very long ago what they're anticipating. And one of the things that they said, they think there's going to be a bit of a bump in retail sales, and they also are predicting, I think it was 5 to 8% drop in retail numbers as far as sales numbers from the standpoint of cost. So savings to the consumer, right? So what they're anticipating is, hey, this is positive news to the consumer. Kind of goes to your point. All right, inventory is now getting here. We're going to have to see dealers anticipating dropping sales price, which impacts profitability. We're going to have to see manufacturers provide incentives, kind of where we were years back. We had that COVID time where there weren't any of those things, right? And there was a lower inventory, and dealers were, enjoying those higher margins of those things. And it seems like we're sort of heading back where it was. And I've talked to some dealers, and the conversations are, yeah, my salespeople have to learn how to sell again, or are having to learn how to sell again. And that really was starting earlier this year, but probably even more so now, based on kind of the things you spoke about, and what we can anticipate. Is that what you're seeing as well? I mean, as far as just, again, we talk about that typical supply demand, but from a retail standpoint, consumers have an opportunity to now, those costs are going to come down if I'm a consumer looking to buy a vehicle, now might be a good time, or certainly in 2025.
And I think when I talk about structural costs and addressing those, I think that's mainly or primarily a manufacturer problem.
Right.
The dealer base, the retail base, I think is obviously there's going to be shared sacrifice, and everybody suffers in that kind of environment in terms of pricing and margin. But I think at the end of the day, the dealer base has already rationalized over the years, right? When you look at, and in my presentation, I have a slide that shows capacity US or North American new vehicle capacity, right? And including forecasts out a couple years to 2028 or 2030, right? And that's increasing all the way to 25 million units North America, right? And that some of those would be exported and for Canada and for Mexico. But when you look at the franchise dealer base, that has, that peaked up in the low 40,000 and is now in the low 30,000. So while while the manufacturers have not done a good job of rationalizing capacity, whether it's, a good outcome for bad reasons, the franchise base has actually gotten smaller over the years. So, and that's good, and because manufacturers are always going to need quality and experienced and scope and scale in terms of retail. So in this current environment, I won't say that the dealers are, you know, home free, but it's a much better position, right? The throughput per franchise is healthy. It's still a
Okay.
strong number, 300, 400 per franchise. At the bottom that would be below 200 or right around 200. Um, you're talking about the manufacturers needing to move inventory, right? Experienced sales force to be able to do that. The other thing is, like I said, we're talking about near record transaction prices. So you
Hmm.
need somebody with experience to be able to sell a lot of units at the highest prices in history,
Sure.
right? That's not going to happen direct. And I think the direct sales threat comes from a couple of different things. One of them being the idea that during the pandemic, inventory was here in the morning, gone in the afternoon, right? And it was this
Right.
mindset of like, well, anybody could do that. Why do we need a dealer to do it? It's the
Right.
times like these when it cycles back around where it's difficult and you need your retail channel to move that inventory, that they're there to do it. So, the dealers will probably, you're right, get more volume in 2025. It may not be better margin volume, but
Right.
there will be more activity. There will be more transactions, and I think, and I'm starting to look at this more and more. And the Amazon Hyundai announcement to me is super interesting because I think that we're on the verge of Amazon creating a marketplace. And I don't by any stretch think this is a threat to the dealers. I think this is actually a great opportunity for the retail base because Amazon is not going to act as a dealer for the manufacturers. They're just discoverability for them, and it's not merely lead generation for the dealers, right? This is actually take that part of the process, which is difficult, that consumers generally don't like, and give it to Amazon, who has experience in doing those online transactions.
Sure.
And what's interesting to me is that when you think about it, a full line dealer group, your your new and used vehicle revenue, and depending how you break it out, but like for example, new vehicle revenue, it can be 38% of the peer group total. And I'm looking at the publicly traded because it's easier to
Right.
get that information. 38% of the group's revenue total, but it only accounts for about 18% of the gross profit, right? So you're working really hard to do something that generates a lot of revenue, but not a lot of profit. Now, if you can sort of offload that process, which the consumer again doesn't necessarily like, and say like, hey, when you buy the vehicle and you finance it and you want to pick it up, you contact us and we'll arrange all that. They still get the credit for the sale, right? Because it's their inventory that's online. But it also frees up financial and human resources to say, let's focus on the profitable parts of the business. And for example, fixed ops, parts and service, is an
Right.
example where you get 10% of the group's revenue, but 35% of the gross, right? So now you can redeploy finances and people into the places where you're actually generating margin. And so I think like as that evolves, and it's a long way, that's in the super early stages. There's one
Sure.
manufacturer in 48 cities, and but I think for the retail channel to be able to say like, hey, this process that's super sticky with a lot of friction that the consumer doesn't like. And what I was saying before is that the talk of direct sales, I think that's one of the narratives that's created, is that like, oh, we and this is not my, we dislike dealing with the dealers so much that can't we just buy from the manufacturers? And it's like, trust me, you don't want that either.
Right.
Believe me,
Right.
you don't want that. um, but But where that process is just so, the consumer finds it oppressive, you say, no, fine, that's an Amazon. You like Amazon, you go deal with them, and
Sure.
we'll do the happy part, which is deliver your vehicle to you, right? And then we
Right.
have the after sales and we have the support and parts and services for you as a customer going forward. So I think that, and Carvana, which is a bad word around a lot of dealers, is like kind of proven that people will buy a large discretionary item like a used vehicle without actually touching it, without kicking the tires. And I think that Amazon getting involved in this and creating a marketplace is an evolution of that process, right? Because Carvana is not a marketplace. In some ways they are, but that's their inventory, right?
Right.
So Amazon is an exchange essentially, but they're also taking some of the process, some of the browsing, shopping, buying, financing, scheduling part of the process away from the dealer and taking it on themselves and freeing up the dealer to go do other things. So super interesting developments, but the bottom line is, I think it is a good time. And I think it's always a good time to be a retail auto dealer. And I think it's just where we are in the cycle. And what does that deal look like? You talk about Cox forecast, and people will ask me, well, what's your volume forecast for the US for 2025? And I say, all of them, every single item, every vehicle that's built is going to get sold. The question is, what
Right.
does the deal look like, right? And
Right. Right.
this is an environment that that deal isn't going to be as good as it was during the pandemic period, but there will be more of them, right? And then I think it's up to the franchise base to understand that, and then to be able to deal with it and rationalize costs and kind of refocus. And I think as that new vehicle gross margin continues to decline, there's opportunities, one, in a marketplace to offload some of those costs to a third party like Amazon. But I also think there's the ability to refocus where the money is, and that would be fixed ops. I think the used car market is gonna come back a little bit in 25. The supply isn't great because of the lease penetration in the last couple of
Right.
years, but I think that's one of the other things that maybe after parts and service will cycle back around, and you're going to see full line dealers kind of like the used car market a little bit more going forward. And again, the marketplace model works with that part of the business too, right? Let the consumer do their shopping and buying process at their own pace, on their own time, on their own computer,
Right.
and then you just complete the delivery and finish the process.
Yeah, the Amazon Hyundai thing, obviously, when that first came out, uh, people in my role were, of course, highly suspicious. And what does this mean? What does this look like? And how is this going to impact our dealer body? But to hear your perspective, it is very interesting to see how this is going to unfold. And again, to your point, um, it doesn't, regardless of what survey poll you look at, the one aspect of the car buying process that is not popular amongst the consumers is the length of time it takes in the dealership to get through that process. So this really could be an interesting twist to that. And again, to your point, uh, fixed ops, which is that's such an important part of the dealership. And frankly, before COVID and everything else, I mean, that was a huge focus on dealers, getting that absorption rate where it needed to be, so you can have that profitability at your dealership. Then we get into this heavy retail flux that, wow, it's every day is Christmas when we're selling vehicles, to now again going back to a more traditional model, if you will, as it relates to the sales and the importance on fixed ops. So really interesting to hear your take on that. While we're talking about different things that manufacturers are doing or whatnot, I don't know what your thoughts are at this point as it relates to Volkswagen, Rivian, the Scout, that whole coming together, and what that looks like. I think there's still a lot of unpacking there. Obviously, in as it relates to VW Scout, there's concern there as well as far as this direct sale approach. And again, they haven't made the first Scout yet, but it's a matter of where this could be going. And again, miles to go before we sleep on this, right? As it relates to the Scout piece particular, and as we look at things that this new administration coming in, what impacts that might have as it relates to their policy, as it relates to EV. So I'm throwing a lot of stuff out at you right now, but
Yeah,
initial
look,
thoughts on that.
and I think though, even from a manufacturer's perspective, I don't understand the logic of direct sales. And this includes Rivian, Lucid, Tesla, right? Because that
Right.
inventory, that unsold inventory is on your balance sheet, right? So this is why Rivian and Lucid have never had a profitable quarter. And I mean at the gross margin line, not at operating or net. I'm talking
Right.
gross. So they're
Right.
not making their bill of goods simply because you pay your cost of goods to build X number of vehicles. And if you only deliver 0.6x, right, those other vehicles are on your balance sheet. So you've paid, right, to have them built, but you haven't collected or booked any revenue from the sale of them. In a
Right.
franchise model, that revenue offsets your cost of goods on the sale to the franchise, to the
Yeah.
retailer, right? So now if I'm, back in the day wearing my Wall Street analyst hat, I'm saying like, well, how do I know what your as a manufacturer, how do I know what your gross margin is going to be when I don't even know if you're going to sell? Now, Tesla benefited from being the only player in the game at the time and
Right.
essentially delivered 100% of their output every quarter, right? Because it's not a lot in the US.
Right.
So if you can deliver 100%, yeah, it's great, right? So that, I don't know, 10% price discount you give a franchise, you keep yourself. I don't think at the end of the day you can be a manufacturer and a retailer for that 10% by any stretch. So not only is it like it just doesn't make sense even from a financial and from an accounting perspective, because anytime the market turns down or you miss with product, all those unsold units you don't collect revenue on. And now as an
Right.
analyst, like I said, on Wall Street, I'm going like, well, I don't know what your gross margin is going to be. How do I, how do I get bullish on your company when if you have a bad quarter, and this is Lucid was, if they built 4,000 units in a quarter, that's all in their cost of goods, but only deliver 1,500, you're talking about $150,000 short of your cost of goods per vehicle, right? Like
Right.
not for the whole company, but every vehicle is over $100,000 short of your bill of goods. It makes absolutely no sense. Not that they would necessarily get there with a franchise model, but it would be a lot closer because those other 2,500 units would have a revenue amount tied to them and put into the income statement, right, to offset it. So I like to believe that logic will prevail in that sort of argument to where, especially at scale, right? If you're this
Right.
small automaker who builds 1,000 of something in a quarter and only sells 800 of them, nobody cares. But I don't know that you can be a full scale manufacturer, even and even beyond what Rivian and Lucid are, and I wouldn't consider them scaled at all yet, even beyond, and they're
Right.
struggling with it. So it doesn't make a ton of sense. And especially, right, if you think about Volkswagen having dealers, right? Like they're
Right.
already there, right? So
Yeah.
the best you would do is eventually create a franchise or a network that looks exactly like the one that already exists. So it's kind of it's kind of a crazy concept to me to think that it's beneficial. And I think to your point, that narrative is created because of the friction in the dealership, right? It's not because it's a better model. People just
Right.
say, oh, if I can go online and click buy, I'll pay whatever price you want. I'll, wait for however long for it. I'll go get it, whatever it is. Just don't make me deal in that
Right.
situation and environment. And the crazy thing too is, and you as you made this point, is that that's the part of the process that the consumer likes the least. It's the part of the business model that the dealership makes the least margin,
Right.
right? So it's like, well, we're banging our head against the wall for this, for pennies when if a marketplace can offload that part of the process and free up the dealer to add value where they actually can, I think everybody benefits. But I'm looking at it like I think, at least at this point, and from what I'm reading and understanding and talking to people and understanding, is that this marketplace is retail dealer focused. It is for their benefit. I think that the manufacturer's benefit is secondary in that instance, and really what it is transparency, liquidity, and efficiency in the retail model that
Right.
keeps that channel open and flowing. So now, as a manufacturer, your benefit is merely that you can maintain production, right? That you don't have to worry about your retail channel backing up because they can't sell, because the consumer takes a turn, whatever it is. It's just so in a marketplace environment, the benefit to the manufacturer is that the retail channel is happy and healthy. And at least that's the way I'm reading it, and again, it's very early and I guess things could change, but not only do I not see it as a threat to retailers, I think it's actually an opportunity for the process to go digital and to go online, which,
Right.
again, Carvana has proved people will buy vehicles that way.
Yeah.
16% of retail in the third quarter was e-commerce, right? People are doing it. And
Right.
and I think that the franchise dealer base has fought against that to maintain control of that process and say, no, we want you in the showroom. We want to look you in the eye, shake your hand, show you what we're offering and all these other things. And again, that's a heavy lift for very narrow margin. And I think it's time. And I think the consumer will have the sentiment around those dealership interactions will change significantly if that becomes part of or a bigger part of the process, with more manufacturers, with more dealers, and that you say, like, there's nobody for me to be mad at as a consumer, right? Because I did all
Right.
this browsing, shopping, buying, financing, scheduling on my own, right? All I did was show up at the dealership, who gave me the keys to my shiny new thing.
Right. Yeah, it's interesting. You would think now we are, as an industry, poised more than ever to go that direction as we got through COVID, and there were and more online transactions where, I mean, people were buying homes sight unseen, uh, literally online, where you have realtors walking through with their iPhones showing the homes and writing contracts and writing deals, particularly second homes. That was a big deal. So it would seem to make sense that, from a dealer if I'm a dealer, I want to position myself to be as e-friendly as possible for these transactions. And I think we are seeing more and more of that. Let's pivot a little bit as
And
we go ahead.
yeah, and I think that, and I think dealers would say, well, you could do that, right? You could go on our website and buy. I think the difference is that Amazon is a brand. It is the
Right.
e-commerce retailer that if they create a marketplace, there's this addressable market that is absolutely enormous and is valued and revered, and you go there and you can find vehicles, and not just your local, right? So I think that's the key thing, is that now you're attaching a big name, a recognizable name, a name with brand equity to the dealer base, and letting them do where their expertise is, right? Take parts of the process that is their expertise, and the dealers
Right.
benefit from that, right? So it's not that dealers don't have websites, right? It's, or that you couldn't buy something sight unseen on a dealer's website. I think what it does is it just creates this huge visibility, and addressable market with a brand name that people value,
Yep.
and then assumes the parts of the process that you don't like or you don't make a lot of money doing, and frees them up to do that. So I think it's an evolution, or if not a revolution, in thinking. But the dealers, I think, have to let go of some of that process, and it will be for the better. And I think they've been wary of doing that.
Sure.
Because you remember in the early days of Carvana, it was like, maybe people will shop online, but they want to be in the dealer to buy the vehicle, right? They want to see it and
Yeah.
touch it. And it's like, oh, they've sold over 2 million vehicles since 2014. And, I feel like that's been proven that that's not necessarily the case. Maybe it's a small, because when you look at new and used vehicles, right, we're talking, let's say 16 new, 35, 36 used, right? So 52 million transactions. And I think there's a big opportunity for the dealers. Maybe not so much that, again, we're not a 17, 18 million unit market because the process is better. Maybe there's an incremental gain there. But I think, what winds up being peer-to-peer used vehicles, or there's an opportunity there for the dealers to say, like, hey, we got this great marketplace and we have this great process now. We can knock out used vehicles, at 3x what we could sell them and deliver them at prior to, right? If we had a salesperson doing 10 sales in a month, we can have them do 30 deliveries in a month because they're not bogged down in this process, right? That's all
Right.
sort of off-site and happening at the consumer's pace. And when they're ready, we're there and we deliver.
Well, look, and we're already seeing some dealers doing that. I mean, if you spend any amount of time on the road or listening to Sirius slash
Yeah,
XM, you're hearing, retail car dealers advertising throughout the country. Hey,
yeah.
go to this site, buy our vehicles. And I know in Kentucky we have a number of dealers that sell a lot out of state and into other markets. So we are seeing that. Sticking to this transition to a different administration and different mindset, different policies. Look, there's lots of you're hearing lots of discussion as it relates to tariffs and trade wars and all these types of things. Um, in my mind, nothing has happened yet. This is a lot of early posturing and discussing. I think our car dealers can relate to a negotiation, if you will. It's already sort of happening. How concerned or how close are you going to be watching? I imagine you'll be watching it closely, but how concerned are you with discussion of tariffs and the high percentage of tariffs and things of that nature that were, again, early discussions right now? I do think it's a lot of posturing personally as it relates to this is how a negotiation begins. But what's your take on it? What do you see from that standpoint?
Yeah, I mean, and I think that the real challenging parts of it are North America, right? And Mexico and Canada.
Right.
That can get sticky, right? Because there's parts and vehicles really that can only be made in those markets because of the cost
Sure.
and the price point of those vehicles. Um, but look, I think what we've seen, and this goes back to Trump's first uh, administration, is that automakers, especially the domestics, Ford, GM, and the Stellantis brands, have backed out of foreign markets for years, right? And 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 that is just an economic and financial decision. Um, it's very difficult. Every region has its own sort of demand profile and vehicle profile, right? So Europe is in a lot of places, or in the big high volume markets, is congested, narrow roads, super expensive gasoline.
Right.
So what we are building and buying here doesn't translate, right?
Hmm.
Now, the issue with that is if you're a global automaker, you don't want to create a different portfolio for every product portfolio for every country, every region, even. So I want to share platforms, I want to share parts, I want to share as much as possible. And if the US is a pickup truck and SUV market, why are we in Europe at all? Right? And you
Right.
just saw that it was loss after loss after loss, and eventually you have to stop throwing good money after bad, and that's the retrenchment into your domestic market that says this is what we do, this is where we make money, this is what we're going to be, and so I think a lot of that happened organically, right? That you
Sure.
had you had companies and industries sort of retreating to their home market. And I think this is just an enhancement or an incremental step in that direction. I agree. Um, on the one hand, you say, well, it's going to create more expensive products for the consumer. And it's like, yes, but it will also arguably protect manufacturing and jobs to the point where now you can buy stuff. Because if we're letting in, and this is any country, I don't just mean ours, if we're letting in the excess capacity of any product of some foreign country, our manufacturing goes away, right? Our own industry goes away. And those people that are employed in those jobs can't buy the thing in the second place. So
Right.
it is super interesting because, when you look at, and I think it's probably a ways away, but if you look at Chinese manufacturers and the threat of them coming into the US, right? We just talked about average transaction price here being $50,000.
Hmm.
So every manufacturer has run away from the bottom of the market. They're, so if you're talking about, a Chinese manufacturer coming in and selling $10 and $15,000 vehicles and taking market share, I'm saying from who, right? The, the only $10, $15,000, $20,000 vehicles for sale in the US are pre-owned, right?
Right. Right.
So that's not necessarily affecting the manufacturing base. Um, I think the threat becomes, and it's obviously what happened with Japanese manufacturers coming into the U.S., which is you let them in a certain price point and then you let them move up market and to every segment. So I almost feel like the tariff thing would be, hey, at this price point, you're fine. In fact, you're helping our market because there's there's people in every state that can't afford a $50,000 new vehicle, right? That
Right.
there's counties and households that, that's probably close to the, to the income, or close enough that you can't be buying a new vehicle with that. So there's probably a part of the market that gets satisfied by cheaper vehicles, but the manufacturers can't make money there, so they're not there.
Right.
So, on the one hand, you say, well, come in, satisfy this part of our market, or, you know, the other option is the government says, hey, GM, Ford, anybody, will subsidize you, which is, politically difficult to sell. Um,
Right.
will subsidize you at the bottom of those markets, but left in a sort of free-ish market, those automakers are just not doing it. It's the same thing with EVs. Why would I build something I know I'm going to lose money on unless you force
Sure.
me to, or unless you make me whole on profitability? So the interesting thing to me is that bottom of the market, right? How do we handle that? Do we let automakers in, a VinFast or who is higher priced, but Chinese manufacturers and say, hey, if you're in $15,000 to $20,000 range, great, thanks for helping out and getting people in, personal transportation. You could start to get $25,000, $30,000, we're going to have a problem, right? And
Right.
you're going to start to see some serious tariffs and so I don't know what the answer is. Definitely watching it, but I feel like a lot of this gets taken care of organically, which is to say, um, manufacturing is being localized because it's so expensive and not profitable to be spread so far when the demand profiles of different regions is so different.
Yeah, I think you make a really good point as it relates to, that there's been this heavy focus on China, right? And not undeservedly in that our president elect, you hear him often, China, China, China. But I think to your point, the stickier part is our neighbors to the north and our neighbors to the south as it relates to Canada and Mexico and finding that sweet spot that works for everybody. That's the part that may be the most challenging.
Because that capacity, remember, was built in a different mindset, which
Right.
was, hey, we can't make money down at the bottom of the market, but we have labor costs in Mexico that can actually help. So we can continue to provide and build affordable vehicles, but we have to do them there, right?
Right.
And so you say like, hey, that compact car segment, Sentra, Corolla, right? Nobody's making money at $20,000 or sub $20,000. Um, but if you can build them, in a low cost region, it kind of makes sense. Now you're
Right.
changing the game and saying, well, no, you can't do that, right? And it's like, okay, well, then our choice is we don't build them at all, and there goes affordability, right? Which is essentially what's happened, or you let us do it, right? So it's getting to decision time, but um, there's consequence to changing the rules this late in the game, right?
Sure.
And for the consumer, right? So then what happens is you do that, and then the consumer says, there goes affordability, right? And it's like, hey, we're trying to protect you from this race to the bottom, right? In terms of cost. And so and then and we're just talking about automotive trade,
Right.
tit for
Right.
tat, right? There's a
Sure.
million other products that says, all right, well, you tariff this, we're going to tariff that. It was totally unrelated, chicken tax versus pickup truck, like, so
Right.
it's super complex in how these things work, and we're not just talking about the auto industry.
Yeah, that's a great point. There's far-reaching, much more further-reaching implications than just automotive and how it could impact the entire economy as a whole, consumer costs as a whole, all those sort of things. Which, again, it's a lot to keep an eye on. And as we're coming up on our time here, let me sort of ask you this sort of, I guess, last question as we head into 2025, and we've talked a lot about, uh, market conditions and where we see that going. Is there anything you want to touch on as we should be keeping our eyes on that we haven't really thought about or talked about at this point as it relates to 2025? What's really, moving forward? What are your thoughts on the new year as a whole? Overall, it sounds fairly positive and what we're going to be seeing, but what are
I
you
think
looking at?
I think it's positive ish for retail more so than it is for manufacturing. The one thing I would say is I remember about this time last year talking about the year ahead for 2024, and I think what I had said was I think 2024 will be a pivotal year for electric vehicles. And what I had said was I think that 2024 is kind of already set. But if there's not a significant improvement in the demand and profit profile of that drivetrain technology, by the end of the year, you're going to see some walk back of targets or
Right.
of, plant building and, battery sourcing and all these other things. And it wound up happening like within weeks of,
Yeah.
like, so I seeing how that played out for me last year, where I was right, I was giving it a much, much longer runway and grace
Sure.
period for it to work out. I would say that I think that this capacity issue, um, for the Nissans of the world, for Stellantis, for Volkswagen, we've heard announcements from BMW. Like, I think that we could wind up in this very, very significant and sudden cost structure rationalization period, where you say like, oh, they'll work through this through 2025 because there's a feeling that there'll be a little bit more volume and whatever. And I fear that that timeline may be compressed to say first quarter, first half of the year, that there's some significant announcements about plant closures, about headcount, that aligns supply with demand. Because I think at the end of the day, not only as a manufacturer, not only do you not want to go back to lower price, and say, oh, it's a $50,000 market in the US. We could do more volume if we went back to a 40. Those products don't exist. Like I said, like Ford doesn't have any more
Right.
cars,
Right.
right? Like, yeah, like that you couldn't do it if you wanted to, right? So, and it was interesting. Ford had their little Eco Sport, which was their lowest uh lowest price point. It was like gone. So
Right.
basically, you just start eliminating from the bottom, right? Like, oh,
Right.
a $30,000 vehicle, no good, right? And it's out. So I don't think it's possible to even go back to a $40,000 market here. And again, I think what that means is that you're not price stays high, volume is going to stay in a range. And now if your
Right.
cost structure is out of whack or not aligned, you're going to have to address it. So that's the one thing I would be concerned about from a manufacturing perspective, is that structural cost adjustments wind up happening sooner and more severely than, this sort of um, waltz through 2025, and then it hits hard and it hits soon.
Which makes it all the more interesting, to your earlier point, that there's this desire amongst some of these manufacturers to also be their own retailers, right? Their own. When you put it in that context, it's like, why would you take that on versus utilizing a dealer network that's in place to assist with these challenges that you very clearly laid out? It makes it all the more, I won't say it's hard to put in the words the understanding of why that's a good decision to do that.
Yeah, and I think and I say to consumers all the time, I say, like, you complain about the products and the vehicles and argue that they're a marginally good manufacturer, like they're going to be a magically good retailer, like, you
Right.
know, you complain about the thing they've been doing for 100 years, like all of a sudden they're going to be good at the thing that they've never done before, and
Right.
it's this weird sort of boogeyman that is like, if you really think about what that would look like, you'll hate it, right? Like,
Right.
something happens and you're going to what? Send an email to gm.com that you have a problem.
Right.
So, the logistics of it, and I think, we kind of, society to intellectually, that's what we do. We think we solve one problem in a very simple way without thinking about the 100 others that we created, which is like, well, I'll just buy from the manufacturer. And it's like, okay, you know what that's going to
Yeah.
look like? You're going to hate
Yeah.
that.
Yeah. That'll
But,
solve everything. So
right,
it's
right. I'm confident that retail, with some tweaking and some adjustment,
yep.
and this little shift in mindset to say like, hey, let's offload some of this frictional parts of the business
Right.
and focus on this better part. Like, I think there's a great opportunity to do
And for
that.
the
And and
dealers
I-
to
and the
be
other
open that the dealers to be open to that and not
yeah.
be resistant to that, but embrace the sort of change that we seem to have coming. Uh, to your point, where you can really do a self analysis on your business and determine where you want to put your efforts and focus on.
Like, I've said for years, like, I think that's one of the best parts of the franchise full line retail dealer base, is that you have this revenue diversity that enables you to say like, hey, new vehicle market bad, let's do more of this. Used vehicle market bad, let's do more of that. Hey, new vehicle market good, let's do more of that.
Sure.
Right? So, and if you look at, and if I use Carvana and CarMax as an example, right, being used only, hey, if that market's bad, the only way out is through, right? You have no choice. You just see it through. If you're a manufacturer and the market's bad or your cost structure's out of line, you got to fix it. There's
Right.
no, and it may be nuanced in terms of focus, revenue focus, but it's important to say, and I think that's what happened around the time that Carvana was created. You had franchise dealers looking at their gross on new vehicles pre-pandemic and going, "What am I doing? Like, I'm
Right.
I'm killing myself for 4.9% gross on these vehicles when my used vehicles are making 9 to 11% gross, right? So why don't I just do more of that?" Oh, and CarMax was kind of like, "Oh, our secret's out," right? Like, we were in the sandbox all by ourselves, and here
Right.
comes Carvana, and then right, and then that market kind of turned, and the new vehicle, because of supply demand balance, was doing 13%, and it was like, "I'll see you guys, you used vehicle guys, later. I'm going over here to do
Right.
13% gross on new," right? And then the parts counters and the service bays have always been there. So that diversity and that flexibility, I think, is key. And as long as you leverage it, right? Like,
Right. Right.
my college basketball coach always used to say, potential doesn't exist if you don't use it, if you don't realize it, right? So you have that potential. Well, now it's going to be one of those parts of the cycle where you need to think about that and you need to move to the things that are going to make you more money.
So, that's a great close, Kevin, because as we talk about all the differences, the nuances, all the things going on in our industry, so much of it still comes down to fundamentals. It comes down to, are you running a good operation? Uh, Again, you can have all this great potential, but if you don't have a real game plan and you're doing things the right way, you don't have fundamentals. And I can say, Kentucky, we're seeing some fundamentals at UK this year. We're very excited about where the Wildcats are going right now after with a great start and being a top 5 program. But it's bringing those fundamentals to bear, and whatever's going on in the outside world, so much of it comes to the things you can control and being wary of those things.
Yeah, and I'll leave you with this, right? So my very extensive reading goal for the year, I'm just about there. But one of the books that I read around the time of convention was Lee Iacocca's book, which he wrote an autobiography, and written in 1984, and he's
Yeah,
talking about lessons that he learned in the 50s in the auto industry, and they are so relevant today. And I'm saying this is a book that was written, uh, it, it was written 40 plus years ago, but about lessons he learned 70 years ago, and it's like it's still relevant. And you're right,
sure.
it just comes back to those fundamentals. And the processes change and the tools might change, but at the end of the day, business is business. And we've all studied it for 100 years, and it works the way it works. And you can't fight Mother Nature.
That's right. So, well, Kevin, look, it's been a pleasure. I feel like we've almost gone. We've covered a lot. I feel like almost Joe Rogan today. This has been a longer podcast than normal, but really good insight and information. And again, appreciate you being here as always, uh, folks that are regular listeners and participate in our podcast. Kevin will continue to bring content to us. He'll be at our convention this year, per usual. In Michigan, and so we're excited about that. And I'll remind everyone now he is with Presidio Group as the
Presidio Group.
director
Yeah,
of
you gotta put
research.
the in there. You gotta put the
The what?
They get you gotta put the at the beginning.
Yeah,
The Presidio
the
Group.
Presidio Group. And so we'll continue to share Kevin's content and what he puts out as he's building this new venture with the Presidio Group. And Kevin, thanks again. It's always so great to have you with us, and really appreciate your time.
To see you, Jason. Thank you very
All right,
much.
take care. Thanks, everyone. And we'll have future podcasts coming out on all kinds of exciting things. And we appreciate you participating.